Welcome back to the deep dive. Usually when we sit down here, we've got a stack of books or maybe a 50-page manifesto on the future of AI.
Right. Lots of words.
Lots of words. We are definitely used to dealing with words. But today we are doing something a little bit different. Today we're looking at a spreadsheet.
It sounds incredibly dry when you say it like that.
I know. The sales ledger. It sounds like homework. Something you'd actively avoid on a Friday afternoon. But here's the thing, and this is why I'm so excited about this one. If you actually look at the rows and columns, if you kind of strip away the formatting, it's not just numbers, it's a map.
It's a map of human behavior.
Exactly. It's a snapshot of what people were doing, feeling, celebrating, all in January 2026.
It's almost voyeuristic in a way.
Right.
And to be specific, we're looking at a very, very revealing data set from Edward Berger.
Right, and we should introduce him properly. He's kind of our guide for this whole journey.
Absolutely. Yeah. So Edward Berger is a veteran in the wine and spirits game. We're talking over 10 years of experience working with the absolute giants. Diageo, Distel, Proximo Spirits.
The big leagues.
The big leagues. He has his own podcast, The Sales Ledger, and his philosophy is pretty simple, but I think really profound.
What's that?
Every number tells a story.
I love that. Every number tells a story. And the story we're looking at today comes from an alcohol importer, and it's focused on the Ugandan market. We know that because the currency is in UGX.
And it's for January 2026, which is key.
Right, because January is supposed to be dry January. People are broke from Christmas. They're on a health kick.
That is the conventional wisdom, yeah. Gym memberships go up. Alcohol sales are supposed to go down. But when you open up this ledger, you see a very different reality.
People were definitely still drinking.
Oh, they were. But what they were drinking and how they bought it might surprise you. It completely flips a lot of assumptions we have about the whole industry.
Okay, so let's unpack this. We've got this massive list. Bottles, prices, volumes. Where do we even start?
We had to start with the sweet tooth.
The sweet tooth.
The sweet tooth of the market. I mean, if you talk to sommeliers or you read wine magazines, you hear about complex dry reds, tannic structures, oak aging, terroir.
Yes, the serious stuff, the stuff you're supposed to like.
Exactly. We're sort of trained to think that a refined palate means a dry palate. But if you look at the actual volume leaving the warehouse in January 2026, the market is screaming for sugar.
Give me the numbers. How big is this gap between what people say they like and what they actually buy?
It is massive. Let's just look at the grape classification. Natural sweet red accounts for a staggering 26.62% of the total grape volume sold.
Wait, hold on. Did you say 26%?
26.2%, more than a quarter of all wine sales. Just sweet red.
Wow.
And if you add natural sweet white, that's another 10.90%, so you're looking at nearly 40% of the market just dominated by sweet wines.
40%. Okay, so compare that to the sophisticated stuff. How did Pinot Noir do?
Pinot Noir, the darling of the film Sideways. It practically doesn't exist on this chart. It's at 0.20%.
0.2. That's a rounding error.
It is statistically insignificant compared to the sweet stuff. Even Cabernet Sauvignon, which is a global staple, a safe bet for a dry red.
Yeah.
It's sitting at about 8.06%.
So do the math. For every one bottle of Cab Sauv, people are buying, 3 or 4 bottles of sweet red?
At least. It's a huge disconnect between critical acclaim and what people are actually consuming.
So is there a specific culprit here? Is there one brand that's driving this sugar rush?
Oh, there is absolutely a king of wines in this data set. And it's not a vintage French bottle. It's not from Napa Valley. It's Four Cousins.
Four Cousins. I see that name popping up everywhere in these rows.
It is everywhere. Specifically, the Four Cousins Sweet Red 750 milliliter bottle. This single product, just this one bottle, accounts for 6.39% of the entire alcohol volume sold.
Wait, let me clarify that. That's not 6% of the wine. That's 6% of total alcohol moved.
Total alcohol volume. Spirits, liqueurs, everything combined. 1 out of every 16 bottles of anything moving through this ledger is a bottle of Four Cousins Sweet Red.
That's wild. It's a juggernaut.
It is. The data suggests that for the average consumer in this market, wine doesn't mean a dry Merlot to pair with a steak. It means a glass of sweet, accessible, easy-drinking red.
So what's the lesson here for someone listening? It seems like it's all about accessibility versus, pretension.
Precisely. We often project what we think is correct onto the market, but the data shows the general public wants approachability. They aren't looking for a challenge, they're looking for enjoyment. And frankly, sugar is enjoyable. It's the path of least resistance.
It really is. Okay, so that's the volume story. People are buying oceans of sweet wine. But here's where it gets really interesting. Volume doesn't always equal money, right?
That is the second big lesson from Beauger's data. We need to talk about the volume versus value inversion.
I noticed this in the category breakdown. Wine is just taking up so much space on the delivery trucks.
It takes up a ton of space. It's heavy, it's breakable. Look at the split. Wine makes up 39.56% of the total volume, almost 40% of the physical stuff.
Okay.
But it only generates 21.97% of the total monetary value.
That's a huge drop, so it's heavy lifting for less cash.
Exactly. You're moving a lot of boxes for a smaller slice of the profit pie. Now look at whiskey.
The inverse.
The complete inverse. Whiskey is about 22.83% of the volume,
Yeah.
so half the physical size of wine, but it generates 34.56% of the total value.
So whiskey is punching way above its weight class financially.
It is the powerhouse.
Mhm.
If wine is for the masses, whiskey is where the margin is. It's dense value. And just like we had a king of wine, we have an MVP for whiskey.
Let me guess. It's Irish.
It is absolutely Irish. Jameson Irish whiskey.
I feel like Jameson has just taken over the world in the last decade. Is it the standard bottle?
It's the 1-liter bottle. Specifically, this thing is a monster.
Yeah.
It represents 5.32% of total volume, which is already high. But it brings in a staggering 6.87% of the total value.
Almost 7% of the entire revenue comes from one single SKU.
That's correct. I mean, think about the risk there. If you run out of Jameson 1L, you are losing 7% of your revenue stream instantly.
And that's not even counting the other sizes.
Right. If you had the 750 milliliter, the Jameson Black Barrel variant, Jameson is basically the anchor of the entire business.
I want to touch on something else here, something a bit more technical, but it's fascinating. There's a column in the source called STDEVP.
Ah, yes. Standard deviation.
For those of us who haven't taken a stats class since college, can you explain what this tells us about how people are buying Jameson?
Yeah, it's actually a behavioral story.
Mhm.
So a standard deviation here basically measures volatility, how spiky the sales are.
Okay.
If you sell 10 bottles every single day, exactly 10, your deviation is 0. It's a flat line. Predictable.
Right. Steady, boring, but safe.
Exactly. But if you sell 0 bottles for 3 days and then 500 on a Friday, your deviation is huge. You have these massive spikes and valleys.
So what does it look like for our MVP Jameson?
It is off the charts. The Jameson 1L has a deviation of 421.01%.
400%.
It's wildly volatile. And remember the Four Cousins Sweet Red we talked about?
Yeah.
It's at 420.56%.
Those numbers are practically identical.
They are. And what this tells us is that these products aren't just trickling out one by one. They were moving in massive waves. This suggests bulk buying.
Right. Wholesalers coming in and just loading up a truck. Or huge restocking orders for big events, concerts, weddings.
That's the story. It's like a heartbeat thump. Thump, these huge pulses of inventory moving out. These are the heartbeat of the industry.
So you contrast that with something steadier.
Like Absolute Vodka Blue 1L. Its deviation is about 36%.
Wow, what a difference. 420 versus 36.
Right. So Absolute is the steady Eddie. It sells consistently, day in, day out. It keeps the lights on.
Yeah.
But Jameson and Four Cousins, those are the wild rides that make the month's quota in a single afternoon.
Okay, speaking wild rides, we have to talk about the Challenger. We've got wine, we've got whiskey. But looking at the charts, there's a third player entering the ring.
You're talking about tequila.
I am talking about tequila. I feel like 10 years ago, tequila was, I don't know, a niche thing. First shots on a big night out, that's it. But in January 2026, it's huge.
It is genuinely surprising. Tequila has climbed to 8.66% of the volume. And get this, 11.60% of the value.
That's double-digit value share. That puts it in the big leagues.
It does. It has firmly established itself as a major pillar. And what's fascinating is what kind of tequila. It's not the gold stuff anymore.
Yeah, I remember the gold. The mixto, the morning after headache in a bottle.
Exactly. That reputation held the category back for a long time. But the clear winner here is Jose Cuervo Silver, specifically the 1-liter bottle.
Silver over gold.
Overwhelmingly, Jose Cuervo's Silver 1L holds 4.81% of the total volume. It's competing directly with the big whiskey brands.
Why do you think that is? Why silver?
Well, if we zoom out, Silver Tequila has successfully rebranded itself. It's seen as a premium, mixable spirit. It's clean. It works in cocktails, margaritas, palomas. It works as a chilled shot without that harsh burn.
It's shed that old college mistake reputation.
It really has. It's the party spirit of 2026, and the data bears that out. While Vodka Absolute, really is holding steady at around 3.5% share. Tequila is just surging past it.
That's a fascinating shift. So we know what they're drinking, sweet red, Jameson, and silver tequila, but how are they getting it? This was the part of the data that really surprised me.
The sales by business type breakdown.
Yes. I naturally assumed, okay, alcohol, bars and restaurants must be the biggest movers. You think of people going out socializing.
It's a very common assumption. We see bars everywhere. We assume they sell the most. But the ledger proves it's just wrong.
Completely wrong. Restaurants and cafes barely register. They're at 1.54% of volume. Even bars are only at 3.74%.
It's tiny. Think about that. Less than 4% of the alcohol flows through bars. The vast, vast majority is moving through distributors and wholesalers, so about 21%, and liquor stores, which is about 20%.
So people aren't drinking out. They are buying bottles to drink in or to stock their own events. Why is the on-trade, the bars and restaurants, so weak on volume?
There's a very clear economic reason, and it's hidden in the average price index column.
I saw that. Bars had an index of 163%. Let's break that down. What does that mean?
It means that if the average market price of a bottle is, say, 100, the bar is charging 163. You're paying a 63% premium at a minimum to drink that same bottle in a bar.
Ouch. And compared to a distributor?
A distributor has an index of 87%. They're selling below the average price.
So you're paying practically double at a bar.
Exactly. And the consumer in January 2026 is price sensitive. They know they can get that bottle of Jameson for much less at a store. They'd rather buy the whole bottle for the price of 4 shots at the bar.
That makes total sense. But there's one category here that I think is the real story of the future. It's not the bars, not the liquor stores.
You're looking at the mobile stockist.
The mobile stockist. This category accounts for 14.39% of the volume. That's huge.
It is massive.
That is bigger than bars and restaurants combined. Almost as big as liquor stores.
What this tells us is that the delivery economy has fully matured in the alcohol sector.
Right.
These are likely smaller, agile sellers, delivery apps, independent dial-a-bottle services.
The Uber for booze phenomenon.
Precisely. And look at their price index. It's 100%.
Bang on average.
They aren't discounting like a wholesaler. They have delivery costs. But they aren't charging the bar premium. They are selling convenience. You don't have to leave your house.
That makes so much sense. You're at a party, you run out of that Four Cousins Sweet Red, you're not going to drive to the wholesaler, you certainly don't want to pay bar prices, you called the mobile stockist.
And 14% of the entire market volume is moving through that channel. That is a significant shift. The store is just an app on their phone now.
It's a complete disruption. Before we wrap up, I want to look at the weird stuff, the anomalies. We've covered the giants, Jameson, Cuervo, Four Cousins. But were there any surprises in the corners of the spreadsheet?
There's always the sparkling paradox.
The sparkling paradox.
Champagne and sparkling wine. In terms of volume, tiny. About 2.06%. Just a sliver. But the price index is the highest on the chart, 194%.
So this is the status symbol.
It is purely aspirational. We see brands like Moët & Chandon, Imperial Brut. They don't move many units, but when they do, they command a massive premium. It's the opposite of the Four Cousins strategy.
And I noticed something about cider, too. Savannah cider.
Ah, Savannah. The dry cider. What's interesting there is the volatility again. It has a value standard deviation of over 114%.
So another spiky seller.
Very. It's likely driven by specific events or weekends. It's an occasion drink. You buy a crate for a Saturday barbecue. You don't usually buy one bottle on a Tuesday.
And finally, we can't ignore the cream.
The cream liqueurs. A surprisingly strong category. Amarula cream.
It's doing well.
It's doing very well. 13.17% of total volume is in cream and liqueur. And Amarula, especially the 1L and the smaller 375 milliliter bottles, are moving a lot of units.
That's fascinating. It's almost a comfort drink.
It fits that sweet tooth narrative we started with, right?
Yeah.
It's sweet. It's accessible. It's indulgent. Dessert in a glass.
So let's bring this all together. If we had to sketch a profile, who is the January 2026 consumer?
Based on this ledger, the picture's pretty clear. This consumer has a massive sweet tooth. They're buying Four Cousins by the crate and ignoring the wine critics. They are incredibly loyal to big Irish whiskey brands like Jameson.
They're starting to experiment with silver tequila, moving away from vodka.
Yes, swapping out their vodka for Jose Cuervo Silver. And most importantly, they're becoming at-home drinkers. They are avoiding the high markups of bars. They're price savvy.
They are voting with their wallets.
They are. And they're relying on liquor stores and increasingly these mobile stockists to bring the party to them. They value convenience and sweetness over tradition and complexity.
It really challenges the marketing images we see, doesn't it? The billboards show people sipping dry red wine in a fancy restaurant. The data shows people ordering sweet red wine from a delivery app to drink at home.
That is the power of the ledger. Marketing is what we wish people did. The sales ledger is what they actually do.
Yeah.
And the data here says the market is driven by sugar, mixability, and convenience.
It's a reality check in a spreadsheet. Now, before we sign off, I have one thought I want to leave you with. We talked about the mobile stockists, that 14% market share.
It's a rapidly growing segment.
It makes me wonder if that trend continues. Are we looking at the slow death of the traditional liquor store, the browsing experience? If 14% becomes 20% or 30%, do physical shelves even matter anymore?
That's a great question.
Then think about it. When you walk into a store, you might see a cool label, a new craft gin, and decide to try it. But if you're just ordering on an app, you reorder what you know. You just click Jameson again.
So does discovery die when the shelf disappears?
Does the algorithm on your delivery app decide what you drink next?
That is a very provocative question. If the screen replaces the shelf, brand loyalty might look very different in 2027. It becomes so much harder for new brands to break in if they can't catch your eye as you walk down the aisle.
Something to think about the next time you tap order on your phone. Edward Boger, thank you for the data. And to you, the listener, thanks for taking the deep dive with us.
Cheers.
We'll see you next time.